Do you see the capital war between China and the US at the moment?
Trade wars are a distraction war. The real battle is the supremacy of capital. American capital wants to dominate, but then so does Chinese capital. And that war is being fought out in currency and financial markets. Trump may well win the trade war, who knows? But it looks as if they're not winning the capital war, given the problems that the bond market in America is signaling. Now, I think we're in a new era now. The Chinese are focused on devaluing the paper yuan against gold because that helps them to devalue their debts against real assets. Those refinancing tensions tend to lead to global financial crises that have been triggered by excessive debt relative to liquidity. That is worrying because it's saying that the system is beginning to break down in terms of its ability to roll debt, and therefore a lot nearer a financial crisis than many people think.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Today I have the pleasure of welcoming Michael Howell, who's the author of Capital Wars. Michael, welcome to the show.
Thanks, great to be here.
What is your most heretical point of view or contrarian view on the monetary system today?
Well, that's there could be a long answer here, but let me try and keep it concise. I think the main thing is that quantities really matter, not interest rates. The modern financial system is very different from the textbook model. It's not about interest rate setting. It's basically about debt refinancing, balance sheet capacity, and the flow of liquidity through the system.
Well, that was a very short answer indeed. And that is also, I think, one of the things that most people know you for. You write a lot about liquidity. Your whole firm is, if I understood it correctly, also based on the global liquidity framework that you've developed. And those are the topics that we will discuss today. So in that sense, what would you define as liquidity? And what is, most importantly, misunderstood about when people refer to liquidity?
There are many different ways of understanding liquidity, but the way that we define it, in order to make this a functional definition, is the flow of cash savings and credit through global financial markets. So that's the definition we use. Okay, liquidity per se can refer to different things. The definition I've just given you is a definition of what we think of as funding liquidity. In other words, the ability to make transactions. Okay, the other definition, which is widespread, particularly among traders, is a definition of liquidity, which is really a market liquidity definition, which is based much more around the depth of the market, the ability to trade in size close to current prices. And that's what people refer to as market liquidity. Now, market liquidity tends to derive from funding liquidity, which is why we emphasize funding liquidity. And what liquidity is not is the conventional monetary aggregates like M1 or M2. Now, I'll come quietly and agree that if we go back 40 or 50 years, M1 or M2, the traditional monetary aggregates, which refer to money, retail deposits in high street banks, were a pretty decent definition of liquidity because the financial system at that stage wasn't very well developed. But in the last 50 years, we've seen this explosion in financial growth. Financial institutions now dominate our activities in many ways. Banks, shadow banks, non-bank institutions like pension funds, insurance companies, hedge funds, etc. All these institutions operate within the financial sphere, and they're not transacting in M1 or M2 money supply. They're moving credit flows. They're using the repo markets. They're using what we think of as a financial liquidity definition, and that's what we focus on.
In that sense, would you say that there's because you argue in your book Capital Wars that that economic cycles are driven by this financial flows, the global liquidity, not by inflation or interest rates. Why is it such a centerpiece of your framework? Why liquidity in itself?
All good questions. Let me try and answer those. The reason for getting on this or having this liquidity focus is very much based on experience. So when I was a lot younger, I worked for an American investment bank called Salomon Brothers. Salomon Brothers was at the time, since been subsumed into Citigroup, but Salomon Brothers was the world's biggest bond trader, and very, very big in forex markets. It was a trading firm, and one of the things that really counted in terms of understanding how market prices were formed and how asset prices changed was the flow of liquidity through the system. And so Salomon Brothers put a lot of emphasis on understanding money flows, understanding the flow of funds within the system. And that's really the reason that it became, if you like, centerpiece to my analysis. Now, why is that the case is the other question. And that is because if you go back to the textbook model of what drives economies, it's very out of date. It's an archaic model. And what that model says is that capital markets exist to raise new funding for new investment projects, okay, not unreasonably. And what is important is comparing the return on that investment, the prospective return, with the cost of capital, which is maybe the rate of interest. And if the prospective return beats the cost of capital, then the investment project will go ahead, and that investment project, that investment spending, will drive the business cycle in a fairly traditional manner. Now, that's fine. I accept that model, but it's very outdated. Nobody really does that type of investment anymore. Capital markets are not being used to fund new investments. What new investment seems to dominate the world economy today is investment which is done mostly in Asia, predominantly in China. It's dictated by the desires or demands of the Communist Party. It's a planned economy. It's not market driven. So it doesn't seem correct to have this model of how the world economy works. And instead, if you look at the complexion of capital markets today, they're dominated by debt refinancing. Okay, we're sitting on this huge pile of debt. Okay, astronomical, $350 trillion of debt. And that debt has to be paid back, okay, or at least rolled over. Now, the spoiler alert is that, of course, it's never paid back. It's only rolled over. And that rollover has to occur frequently. Now, if debt has an average maturity of 5 years, that $350 trillion of debt means that 70 trillion has to be rolled or refinanced every year. And that clearly puts huge demands on financial markets. Something like 3 out of every 4 transactions in global financial markets today is a debt refinancing transaction. And that means that the whole life of the financial system is dominated by debt refinancing. Now, in order to refinance $70 trillion of debt, you need balance sheet capacity among credit providers. And that definition of balance sheet capacity among credit providers is really what we think of as liquidity. That's our funding definition, our funding liquidity definition. Now, of course, liquidity is itself fungible. In other words, it flows across borders, it flows between sectors. And therefore, we need to have a global liquidity perspective, which is why we look at global liquidity as our main focus.
When liquidity vanishes, it does things to the markets. And I would like to know from you, if also from your own experience, if you have maybe a story or an example in your own career where when a flood of liquidity fueled a boom, or when a sudden liquidity drought caused actually a market to crash?
Yeah, I think there's a number of examples that we can cite. In fact, if you look at the chart that I've put up, which I trust you can see, which is looking at the ratio between advanced economies' debt and the pool of liquidity in the world. So this is, if you like, world debt over global liquidity. That ratio seems to be a fairly flat or mean reverting data series. And the point here is that you need debt, or debt needs liquidity to refinance. And somewhat paradoxically, liquidity today rests on a collateral base. And that collateral base is actually defined in many cases by high quality government debt. So there's this symbiotic relationship between debt and liquidity, where debt needs liquidity and liquidity needs debt. And so what you find is that the two tend to grow together. Now, when they get out of line is when you get problems. And if you have too much debt relative to liquidity, in other words, it becomes difficult to refinance that debt, you get refinancing tensions. And if you look at the chart, what you can see through the annotations is that those refinancing tensions tend to lead to global financial crises. And those have been labeled, whether it's the 97-98 emerging market crisis, whether it's the Lehman crisis, whether it's the Eurozone banking crisis, the Y2K crisis. All these different crises have basically been refinancing crises that have been triggered by excessive debt relative to liquidity. And those refinancing tensions express themselves in market collapses, a rush for cash, and central banks have to come back and throw in liquidity. Counterwise, if you look at the lower area of the chart, below the dotted line is the sort of mean value that the ratio is mean reverting back to. So that's roughly speaking about a debt liquidity ratio of about 2 times. If you're significantly below that, let's say 1.7, 1.8 times or there or thereabouts, what you find is you tend to find asset booms. And those asset booms occur because there's excessive liquidity relative to the debt needs of the economy. And so the vent tends to be asset prices. And you get asset price bubbles being blown up through those periods. For example, the Japan bubble, the Y2K bubble, the US housing bubble, and the latest one, which people have called the cryptocurrency boom or the everything bubble, is the one that we've just started to come through. Now, the worrying dimension looking forward, which we can go into, is that ratio between debt and liquidity is slated to rise back quite rapidly over the next 2 or 3 years to its mean value. And that would suggest that this bubble period is really coming to an end.
If we now look at this slide particularly, I see that it starts in the 1980s. Is this coincidence, or does it coincide with actually the decoupling of the gold standards in 1971?
Well, I think the answer is that it starts in 1980 because that's where the data is available to. This is using data from the IMF data bank on debt, and that only begins in 1980. That's the earliest we can go back to. So that's really a fault of the data. But I think you're onto something when you say that the breakdown of what was then the gold exchange standard or the Bretton Woods fixed exchange rate system in 1971 is something that did unleash significant liquidity into the world economy. And that's something which one can come back to because it was really the beginnings, if you like, of the financialization of the world economy. There was a lot of cheap and ample liquidity that was then available.
If we look now at current risks that are ahead, you've just in a recent Substack shared about some main points of what would happen if the US Fed would be too complacent about the debt that's about to be refinanced. It's the also what you've just mentioned before, that this a big refinancing wall that is coming up from 2025 up to 2028. And that could lead to a couple of factors. You mentioned liquidity crunch, a collateral crisis, a dollar funding squeeze. Can you maybe explain more in detail what you mean by that?
Yeah, if you take a look at the chart that I've just put up, this is looking at the growth of US Federal Reserve liquidity. Now, US Federal Reserve liquidity is not the same thing as the balance sheet size, but it's not far off. I mean, it's basically looking or focusing in on the liquidity creating parts of the central bank balance sheet of the US Federal Reserve. And that liquidity, those liquidity components clearly have a growth angle to them. And what we show in the graph is the growth rate, the 6-month annualized growth rate, in fact, of Fed liquidity. Now, what we've done there is to actually project what it looks like over the course of the next 8 months, I mean, through till year end. And what it shows is basically a fairly erratic pattern, but you can see that liquidity growth starts to slow down or skid slower through the second half of the year. Now, there are various reasons for that which come through, many of those technical, but the bias at the end of the day is that the Federal Reserve, at least in its public face, is still angling to reduce the size of its balance sheet. That's what it says it wants to do. It wants a smaller balance sheet. I think that's madness. It's madness because one of the things that central banks have to do, and that's clearly been emphasized by the regularity and depth of financial crises over the last 20, 30 years, is they need to maintain or at least manage the plumbing system in the world economy, the financial plumbing system. It's not just about setting interest rates, it's making sure that liquidity flows through the system. And in order to do that, they need to manage their balance sheet because their balance sheet is one of the factors that causes the balance sheet of the financial sector, in the broader financial sector, to expand or contract. So if there is a big debt load out there to be refinanced, and one of the threats upcoming is that there's a debt maturity wall approaching over the next 2 years, the Federal Reserve's balance sheet will have to be a lot bigger. Otherwise, there'll be refinancing tensions. Now, the slated growth of the balance sheet is depicted in that chart. The slightly erratic picture that you can see projected is, for technical reasons, largely because of the debt ceiling that's currently imposed on the US government and the resulting drop in what is called the Treasury General Account, which is the the deposit account or the balance of funds that the Federal Reserve holds at the US government holds at the Federal Reserve. And then that fund will have to be rebuilt later in the year, which is why you see that slightly seesaw pattern to the chart. But the fact is that liquidity growth is sluggish at best and negative in all likelihood. So that's the picture, and that's not a great picture to look forward to. The little window that you see depicted there is something which comes from the so-called TBAC committee, which is the Treasury Borrowing Advisory Committee. In one of their reports at the end of 2024, projected the balance sheet of the Federal Reserve, and the picture tells 1,000 words, because one of the things that is being assumed by the TBAC committee is that the balance sheet will ultimately expand. So notwithstanding current statements by the Federal Reserve, I think there is a tacit understanding here that the balance sheet has to go up in the medium term in some form. They just haven't come around to it yet, or they haven't told us about how it's going to be done. And that may be because the Federal Reserve is embroiled, as we can clearly see, in politics right now. So that's really the backdrop. Now, in terms of what does it mean, one of the things that you can see on the chart that I just put up is financing tensions in the markets. Now, this is looking at the tensions in the repo markets. Now, the repo markets are really at the center of the financial system today, because the repo markets, if you like, sit between the collateral pool and the liquidity pool. And the repo markets are really where liquidity is created, in many cases, in the modern economy. Now, what you can see in the chart is a line that is dancing around between two tram lines. And those tram lines reflect the normal equilibrium between the SOFR rate, the system overnight funding rate, and Fed funds. And if that spread blows out on the upside, it's telling you that there are financing tensions. There's either a collateral shortage or a liquidity shortage somewhere in the system. And what you can see is a tendency or a trend here towards more and more evidence of collateral shortages in the system. That is worrying because it's saying that the system is beginning to break down in terms of its ability to roll debt, and therefore we're nearer, a lot nearer, a financial crisis than maybe many people think.
So let's hold that thought. What kind of crisis would that be? Because you always talk about the fact that every crisis that we've had in the past is liquidity driven. How would be like the next step or the train of thought be for this coming crisis that you forecast?
I think the best way to see it is to consider this schematic diagram, which is my very rough attempts to try and explain how the world financial system is put together, really has evolved since the global financial crisis in 2008-9. And what it says is that at the heart of the system, as you can see in the center of the diagram, is the repo market. The repo market sits between global liquidity and the pool of collateral. And that collateral is really made up of two broad pots of instruments. One is public debt instruments, in other words, government bonds, and particularly US Treasuries and German bonds, which are often deemed to be pristine collateral. In other words, anybody and everybody will lend against those because they're very safe assets, or at least they were. We can debate that, I suppose. And then the other pool is on the right-hand side under the label shadow banks, which is where shadow banks tend to operate, which is increasingly in private debt instruments such as collateralized loan obligations. But there's a lot of private debt instruments in that pot, and those private debt instruments carry credit risk. Now, the arrow that swings between the public debt instruments and the private debt instruments is labeled regulatory arbitrage. And what that's really saying is because the system is increasingly being regulated and the banks are being constrained more and more, there was a lot of drift in terms of allocations of collateral away from the safety of treasuries into the less certain safety of private debt instruments. And what that means is that in the case of a recession where credit risk goes up, the whole system is at risk of blowing up, but it becomes a very pro-cyclical process. So in other words, recessions can be very bad. Under the old schema, what happened is during a recession, the value of government debt would tend to go up in value because yields would fall, and therefore the collateral base of the economy would expand, and you could lend against that rising pool of liquidity and actually pull the economy out of the recession. In the modern financial system, the financial system is much more pro-cyclical. So recessions tend to reinforce the downward swing in the cycle because private debt tends to be of lower value and collateral tends to be less easily given against vulnerable private credit. And that's the problem. The interventions of central banks occur on both wings, and we show those at the bottom of the diagram. What that is indicating is that the left-hand channel is the normal response of a central bank, in other words, lender of the last resort. The right-hand channel is, if you like, a newer function that central banks have taken on, which you can loosely call dealer of the last resort, which is trying to make collateral good. And those are things like the standing repo facility of the Fed, swap lines with foreign central banks, etc., which are trying to maintain the integrity of collateral in the system. Now, will that work? It's possible, but clearly we're in untested waters in many cases, and that's why I think it's somewhat foolish of the central banks to step back and to try and allow the system to move towards a crisis before intervening. They've got to ensure that the flow of liquidity is adequate the whole time. Now, this is particularly relevant right now because if you look at this chart that I've just put up, this is the volatility of the bond markets. Now, you can see here, this is the US Treasury volatility, the MOVE index. The MOVE index is far, far more important than the VIX index, although the majority of people look at the VIX and not the MOVE. The MOVE is the equivalent, but for fixed income markets. And what I've shown on that chart is a normal zone for fixed income market volatility. And I've also indicated a danger zone, and that danger zone is drawn at 150, mainly because when I was operating the bond markets, it was always deemed that 150 on the MOVE index was a sort of life-changing event, and nothing would really survive above 150. Now, it's been above 150 a few times, even recently, but it particularly got there in 2008, but I haven't shown that data. But you can see where we are now. The MOVE index is elevated, which is saying that you've got a lot of volatility in the bond markets. Now, a sort of quick way to read this chart is to knock a zero off the index and to say that refers very crudely to bond market volatility. So normal bond market volatility would be about 7% per annum. And where we are now is sort of nearer 14% per annum. So it's sort of double, double where it traditionally is. Now, why is that so important? It's important because when you come to borrow against your collateral, the credit providers will give a haircut to the collateral depending on how uncertain its value is. So if you have a particularly volatile pool of collateral, they're going to give you a big haircut on that, which means that whereas you could probably normally borrow 95 cents against the dollar, each dollar you post in collateral, they may cut that to 85 or 80, depending on the degree of volatility in the market. So that collateral multiplier shrinks quite rapidly in an uncertain market environment. And you can see a lot of these things coming together, credit risk increasing, bond market volatility increasing, liquidity shrinking quite rapidly, and then central banks having to sort of chase their tail and having to come in very rapidly with liquidity support. The danger I think we've got is that the Federal Reserve and actually many central banks have sort of decried the value of quantitative easing, which is a foolhardy thing to do because it's absolutely critical in the modern financial system. They have to operate via their balance sheet, whether they call that QE or quantitative support, QS or whatever. It doesn't matter, but they've got to expand their balance sheets in some form, and that window is fast approaching.
So in that sense, there's a drying up of liquidity, and that, if I resume it well, is the biggest danger at the moment. And the markets are also unsure if the Fed is going to proceed in one way or another in cutting interest rates, or, as you just mentioned also in past interviews, undertake some stealth manner of providing liquidity. What could other potential scenarios look like?
Well, as regards the stealth easing, in many cases they've already done that, and they've sort of run out of road in many cases in that regard. And there were ways that they could have actually got around their stated or headline QT policy. And remember, buzzing away in the background, the Federal Reserve is still claiming that they're reducing the size of the balance sheet through quantitative tightening. Now, in reality, they're correct. They are reducing the size of the balance sheet. But if you go back to my original definition of Fed liquidity, I said it was the active parts of the balance sheet that were really critical in judging the Fed's activity. And the active parts of the balance sheet overall, the net of the net is it's been expanding until recently. And that's because of other programs, such as something called the reverse repo program, other things called the bank term funding program, plus you throw in the operating losses that the Federal Reserve is making on its interest rate transactions. All those things are actually adding liquidity to the system and swamping the reduction in liquidity from so-called QT. So has been a net expansion of liquidity. The problem is that the reverse repo facility has basically pretty much shut down now. It's virtually nothing. It's basically tens of billions and that's it. Whereas it was, we're talking about 2 trillion plus at one stage. The bank term funding program has ended. So that was a program put in place after the SVB failure to actually provide emergency liquidity for distressed regional banks. Operating losses are continuing, but that's not really growing that fast. So what you've got is a very, very limited ability of the Federal Reserve now to inject liquidity unless it changes from operating a QT policy to a very explicit QE policy. And that's what the graph I showed you earlier really shows. Fed liquidity is shrinking, or slated to.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, security saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. And so now if we bring it back now to the current actualities in the news, Scott Bessent wanting to reduce the debt burden, you've just mentioned it, the debt wall that's maturing 2025, 2028. There's different hypotheses about how this is going to play out, but the aim is to clearly get the longer end of the curve in control. So the 10-year has been steadily hovering around the 4.3, jumped recently up to 4.5. What are, let's say, alarming levels where you would say this is getting out of control? Is this then the US Achilles heel and all that? How would you describe this?
Well, I think the first thing to look at is to take a look at, if I can put a chart up, of what's happening in the US bond market. And this is showing this chart in front of you is showing the 10-year Treasury yield. Now, this is the most important interest rate worldwide. So it's the yield on the 10-year benchmark US Treasury note. And many derivative contracts and many other financial products are already priced off this yield. Now, what you can see at the top of the chart is an orange line, which is the actual yield. So if that line is rising over time, it's saying the bond prices are falling. If that line obviously falls, then bond prices rise. We've seen a little bit of a fall of late. It's sort of, you can see a channel that is being drawn out there, a smaller channel alongside the bigger one. Yields have come back from their recent peaks, but they're sort of dancing around somewhat above the 200-day moving average, which is that dotted line. Now, to my mind, that's very strange, given the fact that many people, if not the vast majority of pundits, are suggesting we're approaching a recession in the US. And normally in a recession, you'd see bond yields cratering. In other words, falling significantly in anticipation of a recession. That doesn't seem to be happening. And the reason that's not happening is if you look at the lower line, the black line, what that black line is depicting is the term premia on the 10-year Treasury note. Now, this is a daily calculation that we undertake, and what it shows is a trend increase in that term premia pretty much since the second quarter of 2023, and that keeps going up. Now, in actual fact, that term premia on our estimates is still negative. It will have to rise to a more positive level. The scale is on the left-hand side. And it's quite possible that it overshoots and actually starts to contribute a positive amount to bond yields. Now, the reason that that's important is that term premia, or the term premia, certainly since the global financial crisis, has been responsible for something like 90% of all swings in bond market returns. So it's really been the key driving factor rather than interest rate expectations. And that rising term premia is telling us quite a lot. And I think it's telling us that Scott Bessent, or let's be more prosaic, the US Treasury have actually lost control of the long end of the bond market. Now, that isn't necessarily through any fault of theirs, but it's just saying that we're operating now in a more global world. We're moving away from a world where foreign investors were the dominant investors in US Treasuries. Go back to 1999 and something like 50% of US debt was owned by foreigners. That's not the case anymore. It's got right down to under 20%, probably nearer 15%. And the US Treasury is competing for funding in an international world, and that international world is being coloured by Germany's decision to release the debt brake. So we know there's going to be a lot of Euro government paper being issued in the next 2 or 3 years. We've got issues in Japan with inflation uncertainty because the inflation rate is beginning to pick up. And it may be that Japan is finally getting a dose of moderate inflation, which means that the bond market is beginning to price that in. And so the term premium in Japan is going up. The term premium in Europe is going up. And so these are dragging up the US term premium. So the point I'm really making here is that the ability of the US Treasury to control the long end of the bond market may have disappeared through extraneous developments, some of those clearly brought on by the Trump administration's decision, particularly over European defense spending. And that makes it very much harder for the Treasury to attain its goal. Now, understandably, what that really means is in order to get bond yields down overall, you need to put huge pressure on the Federal Reserve to cut interest rates, because even if term premium are going up, maybe you can squeeze a fall in yields out of the system by actually encouraging much, much lower policy rates. Consequently, Jay Powell is being pressurized enormously by the administration to start cutting interest rates. And, that probably is not going to end well because he's resisting. The Trump administration are insisting. And, there's not very much give on either side. But that uncertainty, the market's not going to like very much.
Yes, I've had an early conversation with Louis Vincent Gave. He had a remark saying that there was a current study or a questionnaire or something that showed that almost 80% of the employees at the Fed were Democrats and wanted to stick it up to Trump, basically. And
Yeah,
thereby
I think that's right. I think that's not surprising in many ways that that's going on. Now, I think one's got to contrast what's happening with the Federal Reserve, and maybe in terms of the failure of collateral or potential weakness in collateral prices, with another development that's going on, which is actually in the case of China. And if you look at China, what China's doing, according to the slide that I've just put up, is China is increasing its liquidity injections quite noticeably. Now, in actual fact, since I drew up this chart, they've announced further programs, and that bar is now accelerating even faster on the right-hand side to new heights. And what it's showing is that China is basically injecting more and more liquidity into its financial markets. Now, if you look at the data that we show there is a 3-month rolling sum of liquidity injections. It's seasonally adjusted, which means that a lot of the extreme volatility in the Chinese system is taken out. Not everything, but a lot of it. But it does highlight the fact that over the last few years, China has really operated a stop-go policy where they've hit the brakes hard or then have to jump on the gas pedal at different times because they're simultaneously trying to manage the yuan against the US dollar. Now, I think we're in a new era now where management is changed and the Chinese are much more prepared to devalue the yuan. And in actual fact, that's exactly what they need to do to get out of their debt problems. And the chart that I've just put up here is the counterpart to the chart that I showed earlier on, looking at the debt liquidity ratio for the world. This is singling out China. Now, if you look at the chart for China, what you can see is that the debt liquidity ratio is much higher. It's actually well above average. And that's saying that actually in China's case, we know that there is a mountain of debt that the Chinese have built up, which has been saddling their economy and slowing down growth. And they need to get out of that debt problem because that debt is deflationary and it's been having a very negative impact on the Chinese economy. And the way that you get out of debt is you devalue debt, or more strictly, you devalue or depreciate your paper money because debt is denominated in paper money. And what you ideally want to do is to print enough liquidity to get that debt liquidity ratio down. So what you can see is it's beginning to drop back to its long-term average. And that is exactly what China should be doing right now. Now, the consequence of doing that is that as China is printing liquidity, and as I say, it's doing it rather faster as we speak, the yuan currency, China's currency, would devalue. The key question is, what does it devalue against? And the common belief has been that what will happen is that the Chinese yuan will be devalued against the US dollar, which doesn't make any sense from any perspective because China's already very competitive against the US dollar, evidenced by its huge trade surplus. What's more, the Americans would not accept that degree of devaluation. So what China is really doing is devaluing the yuan against real assets. And as this chart depicts, it's depreciating the yuan against gold. And that is a very interesting thought because it explains quite nicely, I think, what's going on with the gold market right now. Now, the chart that you can see there depicts in black the Chinese yuan versus the US dollar, which is shown on the right-hand scale, and that's dancing around this sort of 7.2, 7.3 area. So the yuan dollar has been, a little bit choppy, but generally stable. But the orange line is showing the yuan gold price. And it's been my contention that the Chinese have focused on devaluing the paper yuan against gold because that helps them to devalue their debts against real assets. So in other words, real asset values are going up. And as a corollary to this, you would expect to see, if we're correct, some stabilization in real estate prices in China, which has been the bane of many forecasters or people who project the weakness in the Chinese economy. They look back to the weakness of the real estate sector. So this should be now stabilizing prices if this is correct. Now, what you can see there is if you look back to early 2022, the yuan gold price was 11,000. When I drew this chart, it was a little bit shy of 24,000, and it's now testing 25,000 yuan. So the point here is that the yuan gold price has more than doubled over this period. And that's significant. That's the big achievement that China has managed. Now, if you triangulate this back to what it means for dollar gold, what you find is that assuming a 7.3 or thereabouts yuan US dollar, we have originally projected that the yuan gold price would have to hit 26,000 in order to get this China debt liquidity ratio that you see back towards its mean level. Could clearly overshoot on the downside, but to get it back to that dotted line would require enough liquidity to basically push the yuan gold price to 26,000 yuan. I mean, we're pretty close to that now, one's got to expect. But if you take that 26,000 yuan gold price and a 7.3 yuan dollar cross, you're really talking about something close to 2,600 for the dollar gold price. So in many ways, that justifies where we are on gold right now. Now, it's not to say that gold won't pull back in any way temporarily, but the point here is that what they're doing is they're devaluing their currency against gold. China is a big producer of gold. Chinese residents own a lot of gold. The Shanghai Gold Exchange is the dominant price-setting mechanism now in the gold market. It seems to have eclipsed London, which was the traditional 19th century haven or pricing mechanism for gold. It's now Shanghai. And that just tells us the premium, which exists every day in the Shanghai market over London, tells us there's a consistent demand from Asia for gold. And this is what's going on. So the point here that we're making in a very simple fashion is that monetary inflation, of any stripe, causes monetary inflation hedges like gold and Bitcoin, for example, to go up in price. And if we're in a world where there's lots of debt, and China has given us a salutary lesson that the only way to get out of debt is to devalue your currency, well, the West in general, to get out of its big debt burden, has to devalue paper money. And that, I would imagine, is what is going on in the background, not all at once, but over a long-term period. And therefore, what investors have got to do increasingly is to protect their portfolios against monetary inflation. And our view would be that debt is expanding at a faster rate than GDP in the West because of welfare commitments like Medicare in America, Social Security, defense spending, all these elements are increasing the public debt burden. It's rising faster than private debt, but it probably in total debt is expanding at 2 to 3 percentage points faster than GDP overall, which means that liquidity has to match that to avoid a financial crisis. So monetary inflation, if you like, is bound to be at high single-digit rates, and therefore, if you're putting together an investment strategy, what you've really got to ask yourself fundamentally is, if liquidity globally is expanding at this trend rate over the next 20 years at something like a 7, 8, 9% clip each year, which assets do I need to own that are going to at least match that or even best it? That's where I should be putting my money. And I would say that gold has got to be one of those, probably other precious metals. I think you've got to have a slice which is in Bitcoin. I think you've got to have high quality equities. You've got to have prime residential real estate. But you probably don't need a lot of bonds. I mean, hold cash by all means for defensiveness, but I can't see what bonds offer, particularly if bond yields are going to be stuck at lower levels. And it's very unlikely that bond yields will be up at 7, 8%, matching this expansion in liquidity. So therefore, asset allocation has to change pretty fundamentally. Now, what I wanted to show as well is this chart, which shows the systematic influences on Bitcoin. And this is something which I think is very relevant because it explains a lot of the recent cycle in Bitcoin and why Bitcoin is now catching up with maybe what the gold market's done and maybe why gold raced ahead over the last 3 months. And what it shows is a number of factors that drive systematically Bitcoin. This is done from a statistical analysis, which, if anyone's familiar with the techniques, it's called vector autoregression modeling. And what it shows using very high frequency data, weekly data since 2015, it shows the impact of global liquidity, investor risk appetite, and gold on the price of Bitcoin. And the takeaway conclusion is that global liquidity is the dominant factor. It's about 40% of the total systematic influences. Risk appetite is an important element. That means that in straightforward terms, if NASDAQ goes up, you'd expect Bitcoin to go up. If NASDAQ falls significantly, you'd expect Bitcoin to come down. In other words, this is people's risk on, risk off behavior. And if it's synonymous with technology stocks or Bitcoin, I would accept that. I think that's a reasonable benchmark. So gold, for example, doesn't have that same risk appetite influence. It's much more a pure liquidity phenomenon. And then the two elements at the bottom of that chart, which are a little bit technical, are looking at gold per se, the gold price, which has a big factor influence, and the gold to Bitcoin ratio. Now, together, if you take those two elements, mathematically, they form what is technically called an error correction system, which basically means, in straightforward terms, that in the long term, gold and Bitcoin are very highly correlated, but in the short term, they could be negatively correlated, which means that if you get a surge in Bitcoin, as happened in the fourth quarter of last year, it's very likely that the focus will be in Bitcoin and gold will lag behind, may even fall. Whereas if you come into the first quarter, what you've seen is then gold catching up and Bitcoin languishing behind. But in the long term, the two will be positively correlated. So those are the factors that really drive the price of Bitcoin. Now, if you look at this chart, which shows the relationship between global liquidity and Bitcoin, the relationship here is pretty good. And this is looking at a long-term correlation since 2015 with movements, 6-week movements in the price of Bitcoin. The reason for doing that is very simply because it gets rid of noise in the data. It would be very difficult to read that chart if I just did daily changes or weekly changes. So it's just purely a filter to stabilize the data a bit. There's no cheating on that regard. And if you look at the black line, that's showing again a 6-week change in global liquidity. but that's been advanced by 13 weeks, i.e. 3 months, to show that global liquidity generally leads the price of Bitcoin. And that, I think, is a fairly impressive relationship, which seems to be holding right now, because even since we've drawn this chart, the price of Bitcoin has jumped up, 94,000 per coin. So it seems to be pretty consistent with what's going on. So that's the general picture in terms of what's happening to monetary inflation hedges, debt, and liquidity.
So that's that actual chart, I guess, is what Howell also shared on X a couple of times about the global M2 12-week lead superposed on the Bitcoin price. Where have you seen this chart before? Have you come across before?
Well, it's not. We don't use M2. That's, as I say, I think a spurious measure. But this is looking at least in my view, this is looking at financial liquidity flows. The trouble with M2 is basically high street deposits of retail banks, or retail deposits of high street banks, I should say. So it's, that's not necessarily. Why should that be correlated with the Bitcoin price? I have no idea. What you've got to look at is flows of money through the financial sector. That's more likely to drive an asset price.
Okay, so you would say that this is not a very good, accurate measure, and that what
Well, I
you
don't know. I
shared
mean,
here
I,
is...
I have I don't look at that, because the point being is that if you look at global M2, it's maybe something like about $60 trillion worldwide, or thereabouts. I forget the numbers, but the figures that we're using are way bigger. We're looking at about 175, 180 trillion aggregate for global liquidity. It's a much, much bigger animal.
And so there was also a question from one of our listeners, and that listener, Uridang3R, asked, so if we hit eventually the depth wall, massive yield curve control, QE, or whatever liquidity injection mechanism they come up with, hits the market, would it be good for risk assets? Or despite liquidity injections, we will be in a risk-off environment due to a potential debt crisis? So I'm not sure if that was pretty clear from the question, but...
So if you look at this chart, what it's basically illustrating is that very problem of the debt wall. And what it basically is arguing is that we've come out of a period, or we're coming out of a period, where that debt liquidity ratio was very low. And that low debt liquidity ratio was really based on two factors. One is that liquidity has been abundant, and that abundance in liquidity has really been caused by the fact that policymakers responded to the global financial crisis by injecting liquidity, and they responded to the COVID emergency by injecting liquidity. So there was an abundance of liquidity in the system. On the debt front, interest rates were hammered down to nearly zero, which encouraged a lot of borrowers to term out their debt. In other words, to refinance at low interest rates. And those refinancings were probably of an average 5-6 year maturity, which if you start at the COVID crisis in 2020, 2021, that means 2025 through 2027 is really the period where you're likely to see a lot of that terming out of debt coming back to be refinanced. And that is the debt maturity wall. So those two factors have temporarily caused that big drop or sag in the debt liquidity ratio. Now what we're seeing is debt refinancing demands begin to accelerate. They will accelerate from the second half of this year. And then on top of that, liquidity conditions are more circumspect, because we don't really know what the Federal Reserve is prepared to do. And the Federal Reserve is really the key player here. The ECB is important, but it's only going to follow what the Fed pretty much does. I don't think they're going to steer an independent course necessarily. People's Bank of China is somewhat different, but the People's Bank of China has more effect on commodity markets than it does really on financial asset prices. So we've got to draw that caveat. So what you can see here is that line beginning to shoot up again as the debt maturity wall appears. That's in the projected period. It doesn't go into, if you like, to a period above, or it doesn't go into the regime above the dotted line, which would be clearly extreme financing tensions. But you can see financing tensions beginning to increase. And what I indicated so a little bit later here is on this chart. You can see the drift in the system towards increasing financial tensions. And I'm just amazed that the Federal Reserve is letting this continue.
If we
So the
now,
short
because
answer is yes, probably.
Long answer short, exactly. If we now circle back to what you mentioned with China, my question to you is very clear. It's a very clear one. Some speculate that this is some new form of a Cold War that is being played on a financial level. Do you see that as the case, the capital war between China and the US at the moment?
Yeah, it's exactly that. I mean, this is what I wrote about in a book I published in 2020, which was not about trade wars. It was about more important capital wars. Trade wars are a distraction. The real war, the real battle, is the supremacy of capital. American capital wants to dominate, but then so does Chinese capital. That they want to dominate, and that war is being fought out in currency and financial markets, and that's really what we're seeing in front of us. What I've been concerned about recently is that Trump may well win the trade war. Who knows? I mean, it's anyone's guess, I suppose. But it looks as if they're not winning the capital war, given the problems that the bond market in America is signaling. And I think everyone's expectation may well have been that Scott Bessent would actually manage to control the long end of the bond market, and that doesn't seem to be occurring. Yields are sort of slipping away. Now, I'm sure he's got more weapons in his armor, and he'll try and pull some clever tricks out. But this is not really a great start, and one's got to be cognizant of those risks. And clearly, the U.S. government needs funding, as does every government. But if they don't get funded, the course of their recourse will be to the bill market. And if you start to issue a lot of bills, as Janet Yellen did over the last 18 months, which was clearly, in the big scheme of things, cheating, if you like, by issuing bills, that's effectively monetizing the debt. And we know that doesn't end well. History shows that. And therefore, that's why I keep emphasizing that, in many ways, this is inevitable. So investors have got to basically have in their portfolios dedicated monetary inflation hedges.
You also wrote that the real battle is the control for the global collaterals, and that this will decide then who wins the capital war. Which collateral would that be? Is gold and part of it, as you mentioned also before, that play at hand that China is undergoing?
Yes, I think it definitely is part of it. I mean, I think that a lot of investors are uncertain about what is true collateral now. I think that when we started 2025, it was pretty clear that the main collateral was U.S. Treasuries, maybe with German bonds playing a secondary role, but those were the two items of pristine collateral. I think now, if you ask people, sort of 3-4 months later, they would certainly put gold there, maybe at a high level, and still have U.S. Treasuries or German bonds. But clearly, the shine has come off the government bond markets, whereas gold shine is still very alluring. And so I think the collateral mix has changed. What people define as safe assets is not always constant. It does fluctuate, and therefore, if you look at this battle for collateral, control of collateral, which is what is part of this capital war, the US is not doing that well in terms of its control of collateral right now. It's clearly going to make the war is not lost by any means, and there are other battles to fight and other weapons to use. But clearly, the bond market is much more important to Trump too than Trump one. Trump one was much more about Wall Street. Trump two is much more about the fixed income markets.
So what would other weapons be?
Well, it could be. I mean, there's a whole range of things they could do. I mean, one could be, issuing dedicated defense bonds. Um, it could also involve that some sort of trade deal incorporates elements which not only embrace defense but also embrace the use of the dollar and purchases of U.S. treasuries. That's not out of the question. So it could be things like that. It could be explicit yield curve control. I sort of doubt that really because it's kind of very difficult for Treasury or central bank really to do that in an international market without capital controls. Um, and I think it's very difficult as well for the US to enact capital controls because they have to fund so much of their deficit offshore. So that would be a difficult exercise in itself. And it very much goes against the whole tenor of what is trying to be achieved here by making the dollar the international standard and wanting it to be, preserving that mantle, and then trying to put in capital control. So I think they wouldn't do that. There are other things. They could basically change the supplementary leverage ratio for banks, get banks more involved in the treasury market. They could increase the other incentives of banks to hold treasuries. I mean, generally, if you look at history, and if you're cynical, I mean, the way that deficits have ultimately been funded is through the banking system, through regulation, or what in Asia is often called window guidance, where you get basically the authorities leaning heavily on the banking system to do the right thing.
Would you say that, like, if now we keep the gold part element in it, that if gold revaluation became part of the financial endgame, what would Western central banks play a role in there? Like, would the U.S. revalue its own gold reserve to regain that upper hand?
Well, I think it's an interesting question. I mean, this is really another dimension of easing the debt funding burden, which would be to revalue US debt. Now, US debt is held on the books at about $42 per ounce. So it's radically underpriced relative to current market levels. And that would generate a windfall gain for the US Treasury of probably around $1 trillion. So it's not something to be sniffed at. It would be a win-win situation. Even though that's only a paper or cosmetic transaction, it would still be meaningful because it would mean they would basically have to issue a lot less debt. $1 trillion less would matter a lot over the next 2 years, particularly $1 trillion of coupon debt. I would be surprised if they don't do that because it's just an obvious thing to do. Although it would seem as if, although Scott Bessent gave the hint that he might do that early on in his tenure, he's now sort of drifted back from that and saying that wasn't really what I meant. But let's see. I mean, never say never, of course, when we're talking about politicians, because I think it is an easy way out. Now, that would mean that the US revalues its gold stock. It's not uniform that every government keeps gold at book value, at cost. Many revalue to market value. I believe I'm correct in saying that the Bank of England does it annually. The ECB does it quarterly. The People's Bank of China allegedly does it sort of on a daily basis, although we're not too sure about that. But that's how they tend to operate. I think Japan follows the US in keeping it at book value. A lot of other countries do, somewhere between the two stools. So it's not, as I say, a uniform process. Many since Scott Bessent hinted he might do that, have come out and said, well, okay, what a great idea. We'd love to do the same thing. So perhaps we'll follow. So I think it could be a win-win for a lot of governments to do this, which would clearly reduce the supply of government paper, albeit temporarily. Now, of course, that opens up a host of questions. One is, what would happen if the gold price fell significantly? Would they then take that? Would they then do the reverse and be forced to issue a lot of debt? That is clearly another question. The other thing is, what happens to the gold price after that? Does the central bank decide it wants to target gold rather like the gold standard? Now, that's a very technical question. I think the answer is that they couldn't afford to do that because the debt burden is continually increasing. And I think in that light, what they need to do is to basically allow liquidity to expand. And if they allow liquidity to expand, to refinance the debt, you must, by definition, have a rising gold price. So they could target a growth rate for gold, but they couldn't target a level for gold. They couldn't go back to the old gold standard. That would be a disaster. I mean, certainly a disaster for the financial system, at least.
That makes sense. I mean, it's unaffordable. My last question to you, Michael, is the one thesis that one of our guests on the show, Henrik Zeberg, makes the case for, is that we are now, a lot of leading indicators show that we are approaching maybe a recession end of the year or soon. But before that the Fed will inject this last liquidity injection, and that we will witness a blow off top in terms of all kinds of assets, especially risk assets. Do you believe that?
No, I don't. I mean, I'll show you a chart, which is why I don't believe that. That's this chart, which basically shows the MSCI World Index in orange, and it's charted against the average cycle in the MSCI World Index for world equities as the black dotted line. The zero on the lower axis is the low point of the bear market. And you can see that where we've traveled over the last 30 months since the low point in October of 2022 is a very standard average bull market. And it looks as if it's rolling over on track. So I think we've already had that blow off top. Have we got a bear market unfolding? I'm not entirely sure about that. I think I would answer that question more, more hesitantly and say that we've got the end of the bull market in liquidity, as far as I can see. I'd be more confident of that. And I think we've got the start of a bear market in risk exposure. And it's those two factors, global liquidity and risk exposure, which really drive our asset allocation process. So it would be a lot worse if the central banks are tightening, and they clearly are not. There's even a case that some central banks may be easing if a world recession occurs. But the problem is that risk appetite has really plunged. And maybe I'll finish by showing you a chart of risk appetite, because I think that's pretty instructive to take a look at. So this, bear in mind, is the second component of what we look at. And this is looking at the world risk cycle. And this is the exposure of investors to risk assets. Zero line is a neutral asset allocation. Depends on the investors, but you can take that as maybe a 60-40 asset mix. If you go above that line, a zero line, each 20 units is one standard deviation above. So in other words, they'd be moving, say, to a 70-30 equity bond split, an 80-20 as they move up. So as they move up there, they're getting more aggressive in risk assets. And as they move down, they're getting more and more cautious, holding more cash, holding more sovereign government bonds, etc. And you can see there's been a big shift down in the last 3 months, both worldwide and more particularly among US investors. And if you pay any attention to those cycles, if there's any relevance in that longer term cycle that we show there as the dotted line, it would suggest a degree of caution upcoming until things are clearer. And I think one of the things that needs to be clearer is the state of the world economy. And our evidence is the world economy is slowing down. And I think there's maybe if I've got a chart there, this is showing weekly economic activity that we monitor worldwide based on an AI system. But it shows that there's been a very significant drop in the pace of world economic growth since December of last year, and notably through the month of April. So you've seen this real skidding of the world economy as tariff uncertainty has bitten. And that's not good for the credit markets. It's not good for liquidity, and therefore it's not good for the financial system.
Mm. But you mentioned that the big beneficial benefactors of at this crisis that you foresee that could unfold are gold and Bitcoin, if I understood it correctly.
Yeah, the other side of the crisis when liquidity is poured in, and the simple reason is you cannot afford. We're in a debt-driven system. Debt is clearly important to our livelihoods, and you cannot afford the financial system to implode. And that's why central banks always have to come in to bail the system out. And their record is remarkably solid here. They've always come in. They've always added liquidity. The price of gold has always been higher. And if you want a benchmark of what the future looks like, I would say just take a look at U.S. debt. U.S. debt in or since year 2000 has increased by something like 10 times. So it's gone up to, the current levels are what in marketable debt at least 28 trillion. The marketable debt total in year 2000 was about 2.8 trillion. So you've seen this whopping increase in the debt burden. And what has the gold price done over that same period? It's gone up by 12 times, pretty much matching, or just more than matching, the increase in debt. So if you think debt is going to expand in the future, I can't see why it doesn't. We've got to hold monetary inflation hedges like gold and Bitcoin in our portfolios. It's as straightforward as that.
But Bitcoin hasn't, in terms of data, that's why I'm very curious about your view of why Bitcoin, because Bitcoin has not withstood any more business cycles since 2008. There wasn't really like an unwinding of the business cycle so far. So hasn't really proven itself either. But you say that this might be still an asset that could benefit from all that.
Well, I think, as I said, right at the sort of in the middle of the conversation, if you look at this diagram, which is looking at this pie chart, I mean, what it's telling you is that the composition of Bitcoin is 40% global liquidity. Now, global liquidity may be flatlining at the moment, but it will likely expand in the future. And it may be that risk appetite dives further in the near term because of concerns over the economy. So you could say that out of those factors, and given the fact that gold prices run on a lot, you may suggest that's going to come back. So you might say, well, okay, in the short term, the negative weight on Bitcoin is negative. Okay, all those factors are not going to drive the Bitcoin price higher. I can't argue against that. But in the long term, let's assume risk appetite is neutral. Let's assume the gold price is neutral, but then global liquidity is going up significantly because of the debt burdens that we have to refinance. And therefore, this is the big driver of Bitcoin. So in the long term, that's the important factor. The business cycle comes into investor risk appetite. It doesn't affect global liquidity, rather the other way around.
Mm. And for gold, how much of the global liquidity share of the same pie chart, let's say, would that be?
In terms of the systematic influences, it's a much bigger percentage. I mean, it's probably about 2/3 of that. And you may have another element which is not risk appetite, but geopolitics that come into the gold thing. But it's much more a pure liquidity play. That's for sure.
Michael, thanks a lot. We've reached the end of our time, unfortunately. But I'd like to thank you for your time and your precious knowledge.
Great pleasure. And if people want to contact me, take a look at Capital Wars on Substack. That's the easiest way.
Yes, I'll put, of course, all the relevant links of your X profile, Substack, your website, all of it in the description down below. Again, thanks, Michael, and I hope you
Pleasure.
enjoyed this beautiful weather outside. That is a bit more positive than the conversation that we had.
Very good. Thank you.